Everywhere you look, you see success stories. Famous musicians fill your playlists and magazine covers. Startups that become billion-dollar companies dominate headlines. Best-selling authors and celebrated entrepreneurs seem to be the norm. But here is a surprising fact. The chance that any one person will reach this kind of success is actually very close to zero. You feel drawn to try because everywhere you look, success seems common. Yet, this feeling is an illusion caused by what we call survivorship bias. Survivorship bias is the error of focusing only on those who have succeeded, while ignoring the vast number who have failed and disappeared from view. It creates a distorted picture that makes success appear much more likely than it really is. The core idea is simple. When we look only at survivors, we miss the full story. This leads us to make bad decisions about risk, effort, and chance. Let's break down this idea with a concrete example. Imagine a musician named Alex who dreams of becoming a rock star. Alex knows many famous musicians, and it feels like they are everywhere. But what are Alex's real chances? Suppose that for every successful rock star, there are 10,000 musicians who never make it big. That means if you pick a random musician, the probability they succeed is 1 divided by 10,000, or 0.01%. To say it another way, if Alex joins a band with 9,999 other musicians in similar situations, only one will become famous, and the rest will not. Now let's build this idea step by step as a probability tree. Start with 10,000 musicians at the base. Out of these, one becomes a superstar. This is 1 divided by 10,000. The other 9,999 do not succeed and quietly fade away. However, when you look at music magazines or concert posters, you see only that one superstar, not the thousands who failed. This creates the illusion that almost every musician you meet might be on their way to stardom. Watch what happens when we extend this to startups. Suppose you consider investing in a new company. Statistics show that about 90% of startups fail within their first 3 years. That means out of every 10 startups, only one survives past 3 years. Of those survivors, most remain very small and never grow into large businesses. Let's calculate this survival rate in numbers. Start with 10 startups. After 3 years, about 9 will have failed, leaving only one survivor. So the probability of survival is 1 divided by 10, or 10%. If you think about expanding this to hundreds or thousands of startups, the survival percentage remains roughly the same. Now consider what happens when you hear about successful startups like Google or Amazon. These stories dominate headlines, but they are from that small group that made it past the initial high-risk phase. Most startups never receive media attention because they fail early and quietly. Survivorship bias doesn't just affect how we view individuals or companies, it also distorts financial markets. For example, stock market indexes like the Dow Jones Industrial Average consist mainly of large companies that have survived decades or more. Failed companies get removed from these indexes and replaced by survivors. This means that stock indexes represent a tiny fraction of all businesses that have ever existed. Many businesses never grow large enough to be listed on the stock market, and many more fail before they can reach that stage. If you assume that the average stock market company's performance represents the whole economy, you are falling into survivorship bias. Let's do a quick calculation to illustrate this effect. Imagine there were 100 businesses started at the same time. 95 of these businesses fail within 10 years, leaving only 5 survivors to be included in an index. These 5 survivors may show strong growth over time, but the overall success rate is only 5%. Now shift to how survivorship bias affects personal decisions and beliefs about success. People often think they can replicate traits or strategies from winners and expect similar results. But many failed individuals shared those same traits and followed similar methods without succeeding. For example, suppose you read that all successful entrepreneurs wake up early, work long hours, and have a positive mindset. You might adopt these habits expecting success to follow. But these habits alone do not guarantee success because many people with those habits also fail. The difference often lies in luck, timing, or factors outside visible traits. Survivorship bias hides this by focusing only on winners who happen to share these features, making them seem like magic formulas. To understand how big this effect can be, consider research studies on health or lifestyle habits. When many scientists examine a question, some studies will show positive results purely by chance. These studies get published and attract attention because they seem exciting. For instance, some studies might suggest drinking red wine increases life expectancy. However, other studies find no connection or even negative effects, but receive less attention because they are less sensational. This selective visibility creates another form of survivorship bias in information. Let's do a short calculation example here. Suppose 100 studies examine red wine and health. By pure chance alone, about 5 of these will report statistically significant positive results, even if there is no actual effect. These 5 studies get publicized widely, while the 95 others remain unnoticed. This selective reporting shapes public perception incorrectly and can influence behavior based on misleading evidence. So, what practical lessons arise from understanding survivorship bias? First, always remember that visible success stories are only part of a much larger picture filled with silent failures. Do not assume your chances are as high as what headlines suggest. Second, when evaluating risks like investments or career moves, look for data on failures as well as successes. For example, ask how many similar startups failed before one succeeded, or how many authors tried before one became famous. Third, be cautious about copying strategies from winners, without recognizing that luck and context matter greatly. Finally, whenever possible, seek comprehensive data rather than anecdotal evidence biased toward winners. Imagine you want to invest in a startup promising a 50% return each year for 5 years. If you assume this success rate applies universally, without considering how many startups fail completely, your expected return calculation will be overly optimistic. Let's calculate expected returns correctly by factoring in failure rates. Suppose the startup has a 50% annual return if it succeeds, but has a 70% chance of failure within 5 years, leading to total loss. Start with an initial investment of $1,000. If the startup succeeds over 5 years at 50% per year compounded annually, calculate the final value as follows. After 1 year, 1,000 times 1.5 equals $1,500. After 2 years, 1,500 times 1.5 equals $2,250. After 3 years, 2,250 times 1.5 equals $3,375. After 4 years, 3,375 times 1.5 equals $5,062.50. After 5 years, $5,062.50 times 1.5 equals $7,593.75. So if successful, your investment grows to about $7,600 after 5 years. Now factor in the 70% chance of failure, which results in losing your entire initial investment of $1,000. Calculate expected value by multiplying each outcome by its probability and adding them together. Success outcome: $7,600 times 30% equals $2,280. Failure outcome: $0 times 70% equals $0. Add these: 2,280 plus 0 equals $2,280 expected value after 5 years. Divide this by your initial investment of $1,000, gives an expected multiple of about 2.28 times your money over 5 years. Now compare this to simply assuming success without risk. You would expect over 7 times your money instead. This example shows how ignoring failure rates leads to overly optimistic expectations about returns. In conclusion, survivorship bias is a powerful force that blinds us to reality by hiding failures and exaggerating success probabilities. It shapes our views on everything from careers and investments to lifestyle choices and scientific findings. By consciously recognizing this bias and seeking out data on failures as well as successes, you can make wiser decisions based on a clearer picture of reality. Success is rare not because it requires secret formulas alone, but because most attempts end in failure without widespread notice. Understanding survivorship bias allows you to see beyond shining headlines and celebrity stories into the full landscape, where real risks and returns live. This sober perspective helps protect your time, money, and expectations from illusions created by focusing only on survivors. Take this knowledge as a guide to navigate opportunities realistically, while still striving toward meaningful goals with clear eyes and steady steps.